Hello and welcome to another episode of the Oracle's Classroom. A few weeks ago, I posted an update on Berkshire Hathaway's Q3 earnings report, and from time to time, I'll do a valuation. I do it for myself, of course, all the time, but from time to time, I'll post publicly Berkshire's value, and so I thought I'd just take some time to go through how to go about calculating or estimating Berkshire's intrinsic value using the framework that Buffett laid out in his 2018 letter to shareholders. So what I've done is I've taken some clippings from that report, and it's well worth reading in its entirety. But just to start, Buffett counsels to focus on the forest, forget the trees. So what he's done is he said that Berkshire's value could be estimated basically by taking, capitalizing its earnings, which are broken down into two segments, and then adding that to the value of two other segments. He calls them groves. And so we'll just dig in. So what I have here is the information needed to do this. You can do it a couple different ways. I've chosen to use a trailing 12-month approach versus annualizing the most recent quarter. And I just want to illustrate what I've done and kind of how this works, and just give a visual for what I'm doing here. So essentially what we are doing when we annualize or take a trailing 12 months is, so we have of course, the full year 2019, and then we have the first 3 quarters of 2020. So to get the last 4 quarters, we simply take the full year 2019, we subtract the first 9 months of 2019, which leaves this single quarter from 2019. Then we add it to the first 9 months of 2020. So that gives us 4 quarters or trailing 12 months. So that's what we're doing here. That's what this information is showing us. And so we'll focus on this last green column as the trailing 12 months quarter. And of course, that's only for the income amounts, the assets, the values of Grove 2 and 4 are a point in time, their balance sheet values. So we'll start right off with the first Grove. So these are Berkshire's 100% owned businesses. The 3 main categories: the railroad, utilities and energy, and the manufacturing, service, and retailing businesses. So these come out again on a trailing 12-month basis to $16.4 billion. And then we take Grove 2, which is the equity securities. And so here there's a little nuance to be aware of that Buffett counsels, that we should take the gross value from the balance sheet, that's $245,317 million, and subtract, that's this this piece here, subtract the income taxes that would be owed if they were sold. So that's what I've done here with this $29 billion. I've just used the 21% corporate tax rate, and this figure, this 140 billion, is the unrealized gain that came from the Q3 report. So that's Grove 2, and then we have the control group businesses. So that is the minority interests in things like Kraft Heinz, Berkadia, Electric Transmission Texas, which is owned through Berkshire Hathaway Energy, as well as Pilot Flying J. So that's another $1.2 billion in earnings. And here I've elected, so this is not perfect, and again, it's an estimate of intrinsic value. I've elected to add back the Kraft Heinz intangible impairments. Relatively minor amount in the grand scheme of things, but there are several items here that are worth mentioning. Last year, if you were looking at this, Grove 1 also had the asset impairment from Precision Cast Parts, which I've also ignored, really because it's already showed up in lower earnings. That's really an asset impairment, and we're chiefly concerned with earnings. So if the earnings are already reflecting that, it would be counting it twice to deduct it. Then lastly, this one really is of little, the word I'm looking for here, really straightforward, I guess I should say. The one nuance here, again, it's relatively minor, but it's something I want to point out. I've elected to only include the cash from the insurance and other, reasoning that the cash in the utilities, railroad utilities and energy businesses are needed for those operations. So, we're kind of concerned about, what could be readily sold and even distributed to shareholders, and so cash that's needed in those operations, will not include as part of our valuation exercise. So then we just we've gone through, we've calculated those numbers, and we come to the summation segment. So I've just here added the Groves 1 and 3 to have one source of earnings to capitalize. And here again, I've elected to use a 15 times earnings multiple for the earnings, which comes out to 6.67% earnings yield. You may choose to use something different. In fact, I guess I'll post this spreadsheet if you want to play around with it. You can make your own assumptions, adjust things as you see fit, and we'll adjust that at the end here when we take a look at the value. I have that 15 times after-tax earnings comes out to about 12 times pre-tax earnings. I had been using a 10 times pre-tax earnings multiple on the old 35% tax rate. So the 12 times after tax on the new tax rate also comes out to the 15 times for after tax. So there's some consistency there. Then it's simply adding the Groves 1 and 3 to the asset Groves 2 and 4, and you come up with an intrinsic value estimate for Berkshire Hathaway of about $625 billion. Then we can take the shares outstanding at the end of the quarter, and that translates into a Class A share just under 400,000, and for the B shares about $265 per share. So again, you can play around with this. If we use a 10 times multiple, you can see what happens to the share, the estimated intrinsic value per share. There's enough of a it's straightforward. It's a pretty narrow range, but there's enough here that two people doing this would get slightly different values for Berkshire. So, I guess, again, just to sort of highlight here some of these questions that you might have going along, what is the appropriate multiple for those earnings streams? Obviously that is dependent upon interest rates. So that can change over time, could change depending on risk or how the investor feels. It's really up to you. You should not look to the market for it. Determine your own opportunity cost really is the best benchmark. And then, another question to ask is, are these earnings cyclically high or low? The case may be made that the earnings, even if we just look at the earnings 9 months of 2019 to 20, a significant decline in the non-utility earnings. So, there may be a case to be made for normalizing those earnings, which would, in this case, if you feel that they're too low, increase them, which would increase the valuation proportionately. Just a question you should always ask. Grove 2, again, So you have depressed earnings, but you also have the equity market, which as of the end of Q3 had recovered. So, looking at Berkshire's portfolio, we're assuming that those are appropriately valued. So are they? Is it worth making an adjustment up or down? That's something that you can do for yourself. You can sensitize it if you wish. It is a big part of Berkshire's value, so it's something that should not be completely ignored. There should be some thought put into that. And then just, it would be, we're counting cash at 100%. Could that dollar be worth more if it were put to work in a major, acquisition or a major commitment, fixed income commitment? It could be, but we're assuming that it's worth 1-to-1. So again, I've cut this segment. This is again from the 2018 Berkshire Chairman's Letter. These segments here, worth thinking through. And as Buffett says, it can be a little mind-numbing to think about going through and valuing every single one of Berkshire's businesses. But this is just one method of doing it. Another method might be to take these assets, subtract from the market cap, and then see what the market cap in the market is implying for an earnings yield for those groves 1 and 3. You could take as some analysts do, take the utilities business and look at the peers and put a multiple on those earnings. You could do it for the railroad. But this is a reasonable check for Berkshire's value. You're going to be in the ballpark using this. Again, I should emphasize, I know I have the disclaimers up everywhere, but do your own work. This is simply educational use only. And, please let me know, if you take a look at the spreadsheet, if I've made an error. Happens pretty frequently enough. And, please share, like, subscribe. I'd love to hear your comments, questions, thoughts in general, anything else Berkshire related or business related that you think we should be talking about. Would love to have that conversation. So thanks for watching. Hope you enjoyed it, and hope to be back soon.